Hello and welcome to the July 2018 episode of Lunch with a Lawyer. And today we're going to talk about setting up a college fund for your child. We've all read in the paper about the next big bubble in the economy is student loans. It was we had the mortgage crisis and that big crash and everything, and then credit card debt was out of control. But now the big thing is student loan debt. And it's well over $1 trillion nationally. And a huge portion of that in default because people just can't afford to make the payments once they graduate out of school, or once their child graduates and they've taken loans out. It can be crushing debt. So obviously planning, starting out early and planning, setting up a college fund, getting a strategy, things like that, is the best way to make sure that your child doesn't graduate from college with a degree and become a part of this national student loan crisis. You don't want your child to be just another statistic once they've graduated with their brand new degree. You want them to get a great start in life and not be weighed down with the debt. So let's do a little planning, because obviously every dollar that you're able to save as your child gets older is $1, actually more than that when you figure the interest and everything else that accrues on your investment, where you put the money, is money that they don't have to borrow later. So it's a great way to do that. So we're going to talk about setting up these funds. Now, a great way to do that is through what's called a 529 fund. Now, it's called that because it was created under the federal tax code, the Internal Revenue Code, under Section 529. It's more specifically called a qualified tuition program. And think of it like an IRA. All right, in an IRA, you're putting money aside for retirement, and there are tax advantages of it. All right, and you're saving towards this future event. Retirement is a future event, just like college for your child, their education. So think of it in those terms. Now, it's a 529 fund is either operated by the state or by a particular educational institution. If you know your child's going to be going to a particular school, maybe your alma mater or whatever. But those are the two places. This was created by Congress in 1996, so it's been around for a while. The main advantages of one of these plans is that the earnings are not subject to taxes. So you put that money in there and it grows, and that growth, okay, that income isn't taxable as long as you spend it properly, and we're going to talk about that. You have to make qualified expenditures out of the fund when it comes time to spend it, and then you can spend it tax-free. Okay. Now, the money when you put it in is not free of tax. So you have to be, it operates like a regular IRA, like with a Roth IRA. Roth IRA, it operates like a Roth IRA. You put the money in after you pay the taxes, so out of your net income. It's not a tax deduction. A regular IRA is tax deferred, so you put the money in before you pay taxes and can reduce your current tax liability. And then when you take the money out on the back end, it's taxed then. So this is like a Roth IRA. You put the money in. There's no tax advantage to put the money in, but when you take it out, assuming you spend it correctly, then it's free of taxes. There are two basic types of 529 funds. You have the prepaid tuition plans and the savings plans. Now, each state will have its own plan. The state of New Jersey has a plan, Pennsylvania, California, all these states have their own plan, and each is somewhat unique. And states are permitted to offer both types, but a qualified education institution can only offer a prepaid tuition fund. And that kind of makes sense. I mean, it's prepaid. You're prepaying the tuition. They know you're going to be going there, and you are putting the money aside for that. So that's the type of fund that they offer. It's not a general savings plan. What is an eligible educational institution that can offer these plans? You want to make sure that if you have chosen the school and you're saving money towards that school, that's a qualified institution. Well, it's generally any college, university, vocational school, or other post-secondary educational institution that's eligible to participate in a student aid program administered by the U.S. Department of Education. So, are they part of the U.S. Department of Education plan? Can you borrow money to go there, right? Can you get a Stafford loan or Parent Plus loan or whatever? So that's what a qualified educational institution is. Now, we're here in New Jersey. Are you required to take New Jersey's plan? Because you live in New Jersey. You have to go with whatever New Jersey has to offer. No, you don't. Okay. Your state's plan may offer incentives to win your business, but it's a competitive market out there. And you may find a plan that you like more. So look around and talk to professionals about this. Investment people, things like that, on what the best deal is for you. But you're not limited to your state's plan. So be sure to compare the features of the different plans before you make that decision and pull the trigger. Now, who's the beneficiary of the plan? Well, anyone can set up and name anyone as a beneficiary. Anybody can set up the plan and name anybody as a beneficiary. It could be a relative, a friend, even yourself. And each plan account has one designated beneficiary. So you can't have one account, several children. Okay. Each child has to have its own account. That person, that beneficiary, is usually the student or future student for whom the plan is intended to provide the benefit. And you can change the beneficiary once you set up the plan. Okay, so if you have several children, one child decides not to go to college, well, you can change the beneficiary and move it to somebody else. Any funds distributed from the plan are not taxable, as I said. And if they're rolled over into another plan for the benefit of another beneficiary, so if like a pension rollover or something like that, is not taxable because it rolls over into another fund. Who controls the funds? So we know the beneficiary is the students, the family member, and they're the beneficiary of the funds, the person who's going to be educated, but who is the owner of the fund? Who controls it? Well, whoever purchases the plan is the custodian and controls the funds until they're withdrawn. So it's whoever sets it up. It's the beneficiary is generally not limited to attending schools in the state that sponsors the plan. So just because, for example, you set it up in New Jersey doesn't mean you have to go to school in New Jersey. But be sure to check the terms, though, before setting up the account. You want to look at all of this. And there are no income restrictions on either you as the contributor or the beneficiary to set up the plan. And there's also no limit to the number of plans you can set up. There are contribution limits, though. They cannot exceed the amount necessary to provide for the qualified education expenses of the beneficiary. If you contribute to a plan, however, be aware that there may be gift tax consequences if the contributions plus other gifts to a particular beneficiary exceed the current limit of $14,000 during the year. So look at the plan, and that's another thing you need to investigate in looking at these different 529 plans as to what the maximum contribution is per year. Now, so that's putting the money in and determining, who can set it up and who the beneficiary is. But I said, money going in is after-tax money like a Roth IRA, but money coming out isn't taxed as long as you spend it properly. Well, what do you have to spend it on? What can the money be spent for? Well, you have to be qualified education expenses, and that's a defined term. And these expenses are relate to the enrollment and attendance in the school, and some of them may be required by the institution, and some must be incurred by students who are enrolled at least half-time. And you've got tuition and fees, obviously, and books, supplies, and equipment. So you got your tuition, various fees, and books. Okay? But beyond that, you can spend other things. You can have expenses for special needs services, for a special needs beneficiary, but must be incurred in connection with enrollment or attendance. So the special equipment or things like that that they need because of a disability or any kind of other special need, that can as well. And for all these things, do your homework when you set up the fund to make sure that if you know that it's going to be special need expenses, that there isn't going to be a problem down the road in doing that. You can include expenses for room and board. Okay, not just tuition and fees, and not just books, but room and board. If they're going away to school, okay, if they're not commuting, they can have room and board expenses. And must be incurred by students who are enrolled at least half-time. Okay, you can't take a class and then expect room and board to be paid for the whole semester. And they qualify only to the extent that it isn't more than the greater of the following two amounts. I know it's getting a little complicated here, and I'll leave some comments and some information in the description of the video, as well as the one on YouTube to this. It's the greater of the following two amounts. Either the allowance for room and board as determined by the eligible educational institution that was included in the cost of attendance for federal financial aid purposes for a particular academic period and living arrangements for the student. And what that means basically is when you, if you were to borrow money and take out a student loan for this school, the school would provide what's called the cost of attendance, the COA. How much is the total cost of attendance to go? How much money do you have to come up with? All right. And so this room and board and everything has to be included in the cost of attendance. Or the actual amount charged if the student is residing in housing owned or operated by the eligible educational institution. So whichever's higher. Right? And again, you may want to contact the school to find out what that is. And if you're setting it up for a school, maybe they can give you an idea in advance how much money that you're going to have to save and what the amount, and also how much before you go paying the bill. Just make sure that it meets these qualifications so that you can take the full tax deduction when it comes out. Now, you can also include the purchase of computer or peripheral equipment, computer software, internet access, and related services if it's used primarily for the beneficiary during any of the years that the beneficiary is enrolled. Now, this does not include expenses for the computer software for sports, games, or hobbies, unless the software is predominantly educational in nature. Okay, so you can't get your child the latest version of Grand Theft Auto and expect to be able to pay for it with this money. Now, what does computer technology or equipment mean? Well, that's another defined term. All right. It means any computer and related peripheral equipment. Related peripheral equipment is defined as any auxiliary machine, whether online or offline, that is designed to be placed under the control of the central processing unit of the computer, like a printer or a scanner, a mouse, something like that. Okay. Does not include equipment of a kind used primarily for amusement or entertainment. Again, that copy of Grand Theft Auto, okay, or the latest game. Computer technology also includes computer software used for educational purposes. So that's what you can use the money for. And just be careful when you start dispersing it so you don't have a tax problem. And just make sure you have all the proper information at the time. Now, is a 529 plan right for your child? Well, unfortunately, that's a question that is really case-based. Hello, Julia. Thanks for joining. Thanks for the like. It's really case-based and depends upon your individual circumstances. 529 plans are not for everyone, and are only sometimes and aren't always the only option available to pay for college. So look into it carefully. Look into the options, different savings plans you can set up. You may want to talk to a tax or investment professional who might have some other ideas for you. Primarily what I'm talking about today is a 529 plan, but there are other things that you can do. There are many independent sources of information on 529 plans. You may want to consider consulting, as I said, a tax professional investment person. Now, you can also get more information from the IRS on these plans. Check out irs.gov. You want publication 970. All right, I'll try to leave a link in the comments and the YouTube description as well on how you can get this form and information. Now, again, this is an overall strategy. Savings of money for your child and the college fund is one portion of an overall strategy for education financing for your child. Obviously, you may, depending upon when you're starting to save, if you have a newborn, that's one thing, but if your child's already in high school, you don't have as much time to put it together, and you may still be having to borrow. And the question you might be asking yourself is am I going to hurt my chances for me or my child to get a student loan if I have this money in a college fund? Great question. And the answer, it depends on what you do and what your planning is, and it's part of your strategy. Your college fund is just one portion of your overall education financing strategy, as I said. So, the financial aid formulas, when you fill out the FAFSA form, the free application for federal student aid, FAFSA, FAFSA form, you're going to get a report back, the student aid report, the SAR, all sorts of acronyms with government, that's going to give you your EFC. That's your estimated family contribution. So, how does a college fund affect your EFC? Well, the more income and assets you have as the parent, the more it's going to change that EFC. Okay, but the good news is that really it's mainly income, not assets, that they look at and calculate in that number. Assets are included in the IFC calculation, but saving for your child's education won't significantly reduce their financial aid award because, number one, income is the major deciding factor in whether you need financial aid. Okay, it's income-based. And savings and other assets are factored into what you can afford to pay, but not as much as you may think. Okay? You come up with some good saving strategies. Here are some points. Okay, number one, don't save the money in your child's name. Okay, that becomes the student's asset. All right, and that is going to have a much bigger effect on their ability to get financial aid if the money is in their name. Okay, so that's why you want to create these funds where your child is the beneficiary and you are a controller, or you're the administrator of these funds. So it's not your child's name. So any asset in their name, whether it's a savings account, trust fund, or brokerage account, is going to count more heavily against them in borrowing. Which is why a 529 account, a savings account, is such a great option. Just make sure you're the owner of the account, and that your child can be named as beneficiary, and the money will still be considered as a parental asset, not your child's asset. Very important. Be careful to use the money from a 529 account if it was owned by a grandparent or other relative. Okay, you as the parent, that's one thing. But if the person who set up the account, somebody else is a grandparent or someone else, while it won't count as an asset, it could hurt your aid formula 2 years after you withdraw the money to pay the tuition bill. At that point, it can be considered income. So you have to be careful there. Now, the next thing is minimize your income. Okay, there are ways of adjusting the numbers. Okay, because the parent's income is the biggest factor in the financial aid calculation. And while you may not want to ask your boss to cut your pay so that your child can go to college, there are some other things you can do. If you're looking to withdraw some money soon from a retirement account, you might want to avoid any capital gains. So if you're looking to sell some stocks, liquidate some things, whatever, you might want to be careful about doing that during that year. So if you do a large bonus at work, for example, see if you can defer receiving it. All right. So it can depend on what your income is at the time you're filling out the FAFSA form and everything else, and getting information from tax returns. Now the financial aid formula is based in part on your income 2 calendar years before the start of the school year. All right. So you can use that window to your advantage. Again, I said it's your income 2 calendar years before the start of the school year. So do your planning and say, okay, maximize your income before January 1 of your child's sophomore year of high school, or defer extra income until after January 1 of their sophomore year of college. All right. So look at where that 2-year window comes in and see how you can adjust your income as best you can under the circumstances within that window. Okay. So that's a way of doing that. The last tip I just have for you, like I said, this is an overall strategy, and hopefully you're watching this video because you have a younger child and you're thinking ahead, which is good. The Department of Education recommends that you start looking at this stuff as early as middle school. All right, so if your child's in middle school, hasn't started high school yet, look at something called the FAFSA Forecaster, FAFSA numeral forecaster. This is an online tool that you can use to plug in some information to get an idea of what you're going to need by the time and what your estimated benefits might be from loans by the time your child is ready to go to college. So as part of your overall planning, run some numbers through the FAFSA Forecaster and see how that could help. All right, so that's it for this episode of Lunch with a Lawyer. Hope that gives you some additional information. I did a podcast, one of the episodes of my Financial Freedom podcast a while back on 529 funds, and I'm hoping in the future through that podcast to interview someone, a financial advisor, tax professional, who can give you more information on 529 funds or other investment opportunities or savings opportunities for college funds. So keep your eyes peeled for that. And as I say in general for these shows, Lunch with a Lawyer is intended to be informational. Okay, just like I provide information in my Financial Freedom podcast, in the other videos on my YouTube channel, richardsonlawoffices.tv, or on my website in articles and FAQs and things like that, and downloads on richardsonlawoffices.com. This is general information, okay? Please don't take this as legal advice or financial advice or tax advice, okay, from me for your situation, okay? This is to get the ideas flowing, to get you thinking about it, to give you the information you need to take the next step, to talk to an investment person, talk to a financial advisor, talk to a guidance counselor at your child's school for more information on this that you may need so you can start your planning. So if you like this episode, please like or love this video on Facebook. And if you know of someone, maybe you've seen this and you're not saving for a child, but you know somebody else, one of your friends is, feel free to share it with them on their Facebook page or just in general with all your friends to get this information out there so that more people can see it and get this great information. I'm also going to be putting this onto my YouTube channel in the next couple weeks. I'll make that available. If you subscribe to my YouTube channel, you'll get a notification when that hits. And if you're watching this on YouTube, please feel free to hit that like button. It certainly helps with the search algorithm. Not only with Facebook, if you like it on Facebook or share it, it'll get to more people. Same thing with YouTube. If you like it or share it, it's going to get more search juice and the information will get better disseminated. And also, if you like the information that's on my YouTube channel, not only the Lunch with a Lawyer episodes, but I have other videos on there, informational videos. Be sure to subscribe by clicking that blue R button and subscribe to the show. But that's it for this month. I'll see you in August for the next episode of Lunch with a Lawyer.